Welcome to the Moulin webinar. My name is Carrie Verberg, and most of you know me as a teacher, but I have been learning how to invest in real estate. I started a company called Further Up and Further In, and we are trying to raise money to help end human trafficking, to help stroke survivors, get a better life and be able to afford things that'll help them, like brain training and neurofeedback. And we are also trying to raise money to dig wells in Africa. We're going to try to be very respectful of your time today. I've scheduled this for just an hour. I'm going to do a short little intro, and then I'm going to introduce our guest speaker, who is one of my team members, and she is going to go over a presentation of a new build to rent opportunity. Then there's going to be a short little time for Q&A at the end. So if you guys think of questions during her presentation, feel free to write them in the chat. You just go down to the bottom of your screen and kind of hover a little bit, and a Q&A will appear, and so will the chat. You can put your questions either in the Q&A or in the chat. Either one's fine. I'll kind of field the questions and let Bethany know those questions at the end of her presentation. If you want to stick in the chat where you're coming from, just shout it out. Hey, you don't have to say the specific city if you don't want to, that's fine. Just say the state that you're coming in from. I see we have Rod shouting in from San Diego, California. We have Chris coming in from LA. Welcome, Chris. We have NChem coming in from Nashville, Tennessee. Oh, wow, we have somebody coming in from Lafayette, Louisiana, and that happens to be where our deal is from. Awesome. All right, so I'm going to introduce to you guys Bethany Finch. She's from American Made Home Solutions, and I'm going to just give her a short little introduction. She is the remote RV investor. She has over 25 years founding and running experience, running 4 separate companies, a credit hacking business, believe it or not, an executive rental business, a single family residential renovation business, and a multifamily syndication business. She and her husband, Kurt, have worked their way from groundskeeper all the way up to owning a multifamily company. At one time, Kurt had over 5,000 doors, all under full renovations across 20 different properties under management at one time. Kurt and Bethany are working to utilize their God-given gifts to further Christ's kingdom while utilizing their many properties in many different markets. Bethany spent many of her years also teaching both K-12 students and adults in a variety of subjects such as higher level maths and sciences. She loves to see that little light bulb go on over their heads of people when they understand something and when opportunities that they never knew were available become available. You can find Bethany and Kurt traveling around the United States in their RV with their security dog, who was named Big Blue. Bethany, you want to take it away?
Well, thank you so much, Carrie. I appreciate that introduction. It always sounds different when you hear someone talking about you. It's like, wait, that makes me sound great. But at the end of the day, I am just like all of the rest of you. I have gone through life, bumped and bruised and figured a few things out and stepped up and got back up and tripped again and got back up. So that's experience has been a wonderful teacher for us, especially in the real estate side of things. And obviously as a teacher, that's where Carrie and I have a lot in common, as well as our desire to make a difference and an impact in this world. Our desires far outweigh our finances. So we had to figure out a different way, right? And as a company, it's the same thing. So what we decided on our company end is everything we do has a give back component, and it's always working towards those same goals. So we want to provide opportunities that allow everyday folks like us to come together and come alongside us and make a difference in these communities. In this case, we're really heavily focused on ending the housing crisis in a way that's efficient and scalable. And so that's actually what we're going to be focused on today and talking about today. So with that, let's dive right in. Thank you guys for joining us. I do want to be respectful of your time, but I also appreciate you taking the time to sit with us, hang with us, and get to know us a little bit. So in this case, I wanted to, you're going to see 3 companies here. So my company is American Made Home Solutions. Legacy Acquisitions is Andy McMullen's.
I don't think you're sharing your screen.
Yeah, not yet. I was just getting to the right thing so I could share it. So,
Just a moment, magically.
Right? No, I want this one. There we go. And share. I'm learning, just like all the rest of you, I am learning the right way and the wrong way to do things, right? And from current slide. All right, so this is our team. Now, the team is comprised of different companies. As Carrie just mentioned, her company is further up and further, wait, I said that wrong.
Further up and further in.
Oh, I did. Oh, see, I almost got it. Further up and further in. And Derek Alexandrenko is Hammerhead Capital. Andy McMullen is Legacy Acquisitions. And I'm American Made Home Solutions. Now, why do we each have our own companies? Well, this is important. Derek is our builder. That's what his niche is. He focuses on building. Andy focuses on finance and the economics and the underwriting and all of that relationship side of things. Carrie and I am the community, not just advocate, but builder, interpreter, you know, all those kinds of things. So that community represents the investors as well as our teams and our residents. So my wheelhouse is everything from asset management to not just running the properties day to day, but how to build our residents up so that they're extremely happy living on our communities. Believe it or not, it is a thing, and we make it happen all the time. So in Carrie's situation, Carrie works with us on the investor relations side, hence you guys. So she will be your point of contact. So any of the opportunities that come along, just know this is all of the teams. She's just your main point of contact. So what that means is I have 27 years experience. Andy has 26 years experience. Derek has 25 years experience. And that wide level of experience allows us not just to be really good at what we do, but be able to see further beyond our scope. And so that allows us to do some amazing things like address housing. So I know that many of you guys know, this is just a little bit more about us. Right now, we have over 3,000 apartment units, 250 plus single family home builds, 1.2 billion in assets under management, 100 plus single family home remodels, 450 million. This is construction. This is currently being constructed. We've done 400 million plus in equity raises, 1,000 units constructed. Our combined is over 60 years of experience. So this is who we are. We're not just newbies, although you may have never heard of obviously us or Carrie talk about real estate, but we're not new to the game. So what the difference is we're extremely picky about our partners. So because we are so picky, we vet every single person. And Carrie passed the test with flying colors. She is an amazing woman and doing amazing things. And when she said, hey, I'd like to come alongside you guys, what can we do? We said, great, let's talk about it. So through that, we are actively trying to address the housing crisis. Every one of you has probably seen either rents going up so high people can't afford it, or they're seeing construction at all-time low. So what happened with COVID was they shut construction down, and the only thing that got pushed through was custom homes. Well, unfortunately, that's not the homes that are in greatest need. The largest demand is workforce housing. And because that got shut down, they're already over 6 million units in the deficit. all across our country. This is something that they actually track, believe it or not. You can go to realtor.com and look at the housing inventory all across this country. But you've probably seen it in your own neighborhoods. And you've seen more people come to your areas, but you aren't necessarily seeing as many options. So what happens in a lot of towns, they allow them to build multifamily units. If they're building, say, a 100-unit apartment building, what happens is they have to wait for that whole building to be done. Then they can start putting occupants in. So there's a huge time lapse in there. This is why we literally said build to rent is an option that we need to start addressing. We need to start educating these cities on, and we need to make a difference here. So we started this in the middle of COVID. No joke, we did. Why? Because we're experienced and we know we could already see where the trend was going, where the needs were going, and how to best suit them. So in build to rent, you'll see, like I said, Freddie Mac, it's totally trackable. But what we're seeing is this younger generation doesn't want to own. One, either because they can't afford it, or two, they don't want the maintenance and the upkeep. So instead, they did learn through COVID, they don't want to be locked in their apartment with their kids, everybody on Zoom and trying to get through the day. They don't want that. So they've decided that they do want houses, but they only want to rent them. They don't want to necessarily buy them. And especially now, as you guys have seen, the rates in the market are crazy. So they just lost over 100,000 of buying power with this latest rate hike. They can't afford that. So that just pushes more people into the renting. So if they have a choice to choose to live in an apartment building with 100 other families in the same building potentially, or live in a house that's in a community, still have all the amenities, still have the pools, the walking, the dog parks, the walking trails, clubhouses, they choose that opportunity every single time. And that's what build to rent is. So we are actually building single home models, all within a community that has amenities. So our very first one was our smallest one. It was 100 units. And that doesn't have a pool, but it does have walking trails. It does have dog parks. It's a gated community. So you get the benefits of that community, but you get to have your own house. They even have their own backyards fenced in and everything. So it feels amazing to them. But we built them in such a way that workforce housing is based on what the workers in that area can afford. So it has to be affordable by the median income. So we focus heavily on that. So when we launched during COVID, we had to stop and think, okay, we're already having supply chain issues. We had to look and really analyze and we've got to keep this affordable. If we can't keep it affordable, now we're not talking poverty level. We're not talking Section 8. Affordable for the workers that are working at that medium income. So that's what we're doing. And the amazing thing about this is the city planning departments absolutely love it because we're able to bring them a solution that they never even considered. It makes a lot more sense to them because now if I build one house and I'm building 100 of them, the moment that one house is done, I can immediately get my certificate of occupancy and I can immediately place a family while I'm still building the other ones. So the best part about that is we're addressing the housing crisis right away, not 2 years from now, but right away. We're also providing infrastructure to help them. One of them required us to build a sewer plant, and we had to literally make the water potable. So we had to build this whole treatment center, and then in 3 years' time, we have to give that sewer plant over to the city. So we just helped their entire infrastructure. Others are we're already wanting turn lanes and things, or fire turnarounds, things of that nature. So we're working alongside them to provide that, and it's a give and take. So it's done some amazing things for these communities. One of the communities had a building moratorium in place, lifted it just to allow our project to come in, and then immediately put it back in place. So we know that there won't be any more supply coming in after us, which is a tremendous boost for what we're doing. So the process, how it works, plain and simple. We buy the land. That's what this first one, acquisition and legal planning, is. We buy the land. We get the land entitled. So that means we get the sign off from the city stating, yes, you can do this project. They've had their meetings. The public has approved. You're good to go. Then you move into engineering and architecture, and that's where you kind of go back and forth with the city wants these setbacks and this and that. Many of these cities don't have building codes in place for what we're doing. They have residential building, single family houses, they have multifamily, but they don't have what we're doing, which is kind of a hybrid. So what's happening is we're literally working hand in hand with them to create these codes. And now once our project is done, now it goes into their code. So it's helping them grow tremendously. We then go through and adjust our underwriting based on all the costs and things that we've incurred along the way. And then we move to the horizontal site development. So what that means is we've got the city, they approved all the plans, they like this, they like the setbacks, everything is good to go. All the paperwork is filed. Now we're going for the actual putting in of the infrastructure. So that means we're putting in sewer, we're putting in power, we're putting in roads, curbs and gutters. We're doing tie-ins to the city. Or like on this other one where they made us build a sewage treatment plant, right? We had to build that. So that's all the horizontal. So think the dirt and below, right? That's what we're doing. Everything that's necessary before we can go up. So the last phase is that vertical phase. Sometimes what you'll see is that horizontal phase, they'll clear trees and things, and then suddenly you'll see roads, right? All the sewer and everything had to go in first. So you don't always necessarily see that sometimes, but the vertical side, everybody sees, because at that point you've got roads in place, you've got power in place, and now you're building up, you're building your foundations and you're going up. So the interesting thing about this is at every part of this, you as an investor have an opportunity to come alongside. And that's what so many people just don't know is available to them. So why do we pick the markets that we pick? This is a market that we actually have two projects going in. Our first one, which is 100 units, and then our third one, which is 241 units, is going on. And that's the one that we're actually talking about right now, and that's the Moulin. So some awesome opportunities here exist. Any of you guys that are in the California area, not so much in Tennessee, but I know a couple of the folks here from Colorado, one of them's from Washington. You see not only the housing crisis firsthand, but you also see the exorbitant costs. How could anybody afford to build in some of these areas? The costs are so high. And if the cost is too high, then we can't provide a product at a price that the workers can afford, right? So we have focused on the Southeast for quite a while for these projects because they're the fastest and easiest for us to get into. Those cities need the most assistance. So when we come alongside and provide a solution to them, they welcome us with open arms and are pushing things through to get things done as quickly as possible. They're not the ones standing in the way. Like one of my buddies in Seattle, it took him 3.5 years just to get his permits approved. 3.5 years. That's unbelievably slow. And they're not trying to speed that process up. These ones are working side by side with us to make sure. So this is why we go to areas that we're going to. You guys all know Walmart, McDonald's, Starbucks, Home Depot. Yeah, those companies have massive research departments. They heavily research the areas that they are in because they obviously want to be in areas where traffic and people are going. So if they're in those areas, you can bet there's a minimum amount of growth, and they're anticipating more because they don't go to an area that's stagnant. They only go to areas that are up and coming and growing, because then they'll start putting multiple locations in. So in here, all of those are already located here, even a Walmart Supercenter. We also have La Quinta Inn and Suites, and there's another one that's hiding over here, and it's another hotel that specializes, Hampton Inn, that specializes in extended stays. So there's a transient population. Why is there a transient population? Because there's not enough housing. So the work is there, the people are there, they just need a place to live. And that's exactly what we're addressing. So the same thing, we have to keep it affordable. So if you look at these numbers, the median home cost in Seattle, Washington, where I'm from, $851,000. Lafayette, Louisiana, $182,000. It is 78 less expensive there. So that means we have to be even tighter on our numbers, so we're not going over budget, because they still need to be able to afford it, because wages often compensate, right? So we have to keep that in mind, and we have to be very conscientious. Hence the reason experienced folks like us that have gone through and been are so imperative to a deal being successful. In this case, this is the layout of all the work that's in this area. And this was, again, from 2020 when we started all of this. So there's tons of different kinds of jobs. And the reason that is so important is because what did we see in COVID? Restaurants shut down. So if your entire economy, or tourism, shut down, right? So if your entire economy is based on restaurants and tourism and they're shut down, your economy is just crashed. So in this case, the restaurant and food services is only 8%. Colleges, universities, that's 19%. A good number, but we also saw shutdowns there. So then you also have motor vehicles and motor vehicle equipment manufacturing. We have regular construction. Some of the regular construction got shut down, right? But then look at all the rest of these. We got public centers, we got insurance, we've got farming, we got scientific research and development, we've got computer systems, we have oil and gas all throughout this area, and all the manufacturing that goes along with oil and gas. So that diversity allows for a growth that continues to grow steadily and strong, and it didn't get as impacted during COVID. So that's why we focus on these particular markets in these areas. So the Moulin, let's just talk briefly about what we're doing here in specific, and then let's talk about how you come alongside and how you have the opportunity as well to address this housing crisis. So this is actually a site plan. So this is what gets drawn up with our architects and engineers, and the city has to approve. Every one of these little rectangles is a house. This is 241 units. It's almost 30 acres. In this process, we have to build roads, we have to build turnarounds, we have to build retention ponds, we'll be building our walking trails. So in this particular situation, when we went to go buy it in December, the city wanted to have another meeting. So we just haven't updated this little bit of it here. We ended up closing in January because the city wanted to do one more public meeting. They did that one more public meeting, and in doing so, we got full approval, and it was fully entitled before we even closed on our loan. We ended up closing and buying the land at the end of January. That is a huge mitigant against the risk, because now the city has said this project is going forward. We may have design changes or things, but this project is happening. So any investors that come in that early phase, once you get that entitlement done, your risk is substantially dropped down. So the next part is that in engineering and environmental. So the engineers are basically just structuring it the way the city wants. They go back and forth with us. And we want this, we don't want this, we want this, we want this. But then we also do our environmental studies. And depending on what they reveal, the city may put more constraints or not on us. In this case, we've got the Army Corps of Engineers. They're the ones that go through all of it. And then once the sign off from them happens, the city says, okay, we're good to go. So that's where on the first project, we ended up having to build a sewage treatment plant. And originally that wasn't in the plans. And then it had to be upgraded. So again, that was not in the plans, but we built in contingencies, and we knew that. We always plan for what if the city says this, or what if life happens, right? So some of the other things that go forward in that are shortage on workers. Like there were times we couldn't get people to show up to work. So we've got to deal with that. That means our project gets delayed. We've got to find other ways. Maybe we have to hire different kinds of help, like short-term help instead. This whole project, we'll have our engineering and environmental approvals this summer. That'll be taken care of. All of the horizontal construction, once that engineering and environmental approvals are done, we can immediately start going through our horizontal construction. And that's going to be started and completed early part of January 2024. Then we can go into our vertical construction. Remember, we're going to go up, and that starts in 2025. and we expect to be fully stabilized by 2026. So the great thing about that is within 3 years, now keep in mind, these are single family homes, many of them, some are duplexes and some are fourplexes, but the majority of them are single family homes, 2 bedrooms to 4 bedrooms. So the moment we get one done, we're moving families in. So all along this 3-year period, we're moving families in and moving families in and moving families in. So this is some of our unit mixes and what they look like. So this is a townhome kind of concept. You can see very narrow, but it's 1,400 square feet. This one's 1,272 square feet. So this one is just a ground floor unit. This one is a 2-story unit. So very, very similar designs, right? We keep the uniformity, we can build things to scale, and they can go faster. The other part of it that we're doing to continue scalability and efficiencies, we're doing off-site construction. So we actually have a factory in Florida that's going to be building our homes on site and then transporting them to the site. These aren't manufactured homes, guys. These are stick built. They're just considered off-site built. The standards these are built to are just as rigorous as our regular stick built on site. So we still have to follow the exact same, but the benefit of that being constructed off-site, the weather delays won't cause us any problems. We can truck them in. We can get 50 of them up in 2 weeks' time, as opposed to 10 to 12 starts a month that we'll be doing on the vertical for the regular stick builds. So it allows us during those peak seasons where weather is great to do a much bigger boost of our product and get it out there.
Bethany,
yes.
Explain stick built, because I don't think all of our audience might know what that means.
Oh yeah, good idea. So stick built is when you pour a foundation in the land and you actually build a frame of the house and then you put the siding and the windows. That's called stick built. Manufactured homes are built in a warehouse, but they're not to the same standard. Modular homes are built in a warehouse, and that's what we're referring to as modular. So the same codes that the building inspectors have to follow and that the builders have to get past when they come inspect the homes, those same codes have to be followed in the warehouse for the modular. And then when they're brought back out, they have to be inspected and they have to follow the exact code. Manufactured homes don't have to do that because they're not even usually on a foundation. These are all on foundations. So in here, these are some examples of what we're building. This is it's called a shotgun style home. So it's kind of a long, the theory was invented years ago. You could stand at the front door, you could shoot a gun from the front and it would go all the way through to the back door. That's the premise behind it. But this is an example of our 3-bedroom, 2-bath. Beautifully done interiors, beautifully done exteriors, high quality. Many times when these multifamily operators and things are building their multifamily, they're just doing what's called rental grade. These have not just stainless appliances throughout. This is granite countertops. These are tile backsplashes. These are solid wood cabinets. This isn't MDF or particle board. This is quality. Again, we have listened to the cries of the people, so to speak. Everybody wants the quality, but as builders, we know if you put in quality, it lasts longer. So your return on investment actually is there. But we also had to find ways to keep the costs down. So what you see down here, this picture is a little bit better picture of it. We've stained the concrete. So instead of installing flooring, that same concrete that was used for the foundation, we've stained it. And we've saved thousands of dollars per unit to stain it and not have to install extra flooring. We've also installed up here along the roof line the sheet that creates this amazing look, but it's actually highly efficient for cooling purposes and heating purposes. So it keeps the expenses down as well. Something as simple here too is, see these little windows? Most people don't stop to realize those little windows are actually beneficial because in this really warm climate, this is Lafayette, Louisiana, it's very warm many times of the year. That sun bakes this living room area, and then the heat costs rise, and then they have to cool it down, and then you're putting too much stress on there. So again, we wanted to think efficient. How can we keep things efficient and keep the costs down? So that's what we've done. And here's some more pictures of the kitchen area. You can see, again, quality all throughout. Here you can see out to the backyard, green. Everybody has their own backyard, has access to it. So what does that mean for you as an investor, and how does this work? So you as an investor, the way it works is ultimately our entire budget is 32.7 million. Now, 26 million of that comes from bank loans. So we've already been qualified by the banks. We already have these loans in place. Some of them, they just get started and stopped in different time sequences. But we have 26 million already approved from the banks, and they're loaning us that amount. So we bring $6.5 million to the table to come up with the rest of it, which is what our $32.7 million budget is. Now, the way this breaks down is the land, obviously it was 1.8 million. So we've got certain expenses that come in here. We've got 950 land costs. We've got closing costs. We've got soft costs that had to go in there. That's all of the soft costs are usually your plans, your architect, your engineering, things like that. But remember, again, I talked about that contingency. Here it is, right? To build out the units themselves, it's about 130,000 a unit. Can you guys build a house that cheap? Not usually. So it's huge when we can do things to scale. There's a huge cost savings. We can buy products at sale. We have supply chains that they would much rather fill our order than a single family person who's only going to do one. They kind of cater to us. We get a lot bigger discounts and things of that nature. And then we have our legal and acquisitions and closing costs and things. Obviously, we have a lot of lawyers watching everything. We have our lawyer. The banks have their lawyer. We have our lenders have their own, because the banks and the lenders are sometimes two totally different people. Sometimes we're going through a mortgage broker. Sometimes we're going through local credit unions. So part of our debt that we've acquired, our local credit unions can only do so much. And so then we're going and getting another bank loan after they've tapped out and things of this nature. So we have lots of lawyers watching everything we're doing. So in here, this is just more about the actual, this is comps that are in the market that we're in and what their square footage is and their bed bath count and what they're also offering. So the good news is that just goes to show you they're getting these rents all the way from 1,185 all the way up to 2,325 or 328. And that's only for a 3-bedroom. Some of our units will be 4 bedrooms. So they're currently getting these rents. So that's a huge bonus to us because we know the plan works, the model works, it's happening and people are paying it because they can afford it and this is working. If they couldn't afford it and those numbers were inaccurate, you would see a lot of vacancy in those products, and there's not. They're just like us. We already have a wait list. We already have a wait list started and going, and it's actively being sought out. Every time we literally have people driving by and they come and, hey, when is this going to be ready? Asking. So this is how it works for you, the investor. So along the way, we are always analyzing risk. We want to protect not just you, the investor, but us as our companies and our community. We don't want to burn a bridge and be like D.R. Horton, who is no longer welcome in certain states, right? We want to provide a quality product that meets that needs of the housing crisis so that all these other communities recognize that and they do just like they're already doing. They come to us. They're seeking us out. They're finding scenarios and ways to get things done. So in doing this, we mitigate as much risk as possible to make the project even more successful, but also give you peace of mind as an investor. So building in a contingency reserve is huge and important and necessary. We're only underwriting for rent and expense growth at 3%. This particular market actually has a 10% rent growth minimum year on year. We're underwriting it for 3%. We're building in extra cushions. We do our underwriting assuming there's no refinance, even though it's pretty likely that they'll have a refinance. If the numbers work without a refinance, when you put the option in to refinance it, it makes the numbers even better. We're looking at our exit cap rate and looking at 80 BPS above the current market cap rate. So what that means in commercial real estate, for those of you who are completely unaware, if you as an individual try to sell your house, the appraiser comes, looks at your house, and then he looks at all the other houses that sold in that area and says your house value is this based on all those other sold ones. In the commercial real estate, it is not that way. The value is 100% driven by income. So what that means is however much money you have coming in minus your expenses is called your NOI, your net operating income. Then they determine the cap rate, the rate at which the capital is trading in that market. They determine that market cap rate. Some markets, it might be 5 or 6. Back in Seattle, it's only at 3%. In some of our Alabama markets, it's 10%. So depending on what that cap rate is, they take that NOI and they divide it by the cap rate and they determine that's the value of the property. So obviously the higher income you have, the more value you have going in. So when we're looking at and projecting in the future what the value of the property is going to be, it's based on how much are we increasing the value by increasing the income and decreasing the expenses. With that said, we're also, you can either keep the cap rate the exact same and have no change to limit your variables, but all of us know that markets change. So because we know markets change, we estimate that. And right now, the market may be stable, say at a 6% or a 7%. But we estimate based on where's the market at in the curve. Every market has a cycle and it's usually 10 to 12 years. So if that's at the top of the curve, we want, and we're looking at, 5 to 7 year hold, well, that's going to be halfway through that cycle. That means we could be at the bottom of the curve. So we run our underwriting based on that, not based on the top, because that means we're going to have to hold it for that 10 to 12 years, that whole time. Our plan isn't always to sell. We pick and choose which properties will be sold for those capital gains. If we choose not to sell the property, like this one, we will probably not be selling. We will simply do a refinance with the banks. So what that means is all that construction debt that we had and the equity that you, the investor, brought to us, and our money, we invest right alongside you guys. We have just as much skin in the game. We have a lot riding on things. We have personal guarantees in some situations. We're putting up our companies or land as collateral. We are fully invested. You are not the only ones that are invested, I promise. And with that, at the end, when now the property is up, everybody's income, all the units are rented, income is coming in, it's fully stabilized, the property's value can be assumed based on that market, and we can get an appraisal done. And now we can then refinance the property, take all the debt that we have, which is your equity shares, my equity shares, and that previous bank loan. We can pay it all off and still pull out even more equity, plenty more, to not just be able to pay you off, but to be able to pay you good returns. So what that means is ultimately you're going to see an equity multiple of your money of about 1.7 to 1.83, right in there. Now, you could potentially basically double your money in that 5 to 7 year hold. We say hold your 4 years. I tell everybody, in your mind, say 5 to 7 years. The reality is it's closer to 4 probably, but it could be 5 to 7 years. So if you plan for the worst, hope for the best, right? So this is what the brass tacks comes down to. So this is what's called a waterfall. If you've never heard of a waterfall, all it means is, just like it sounds like, how the money is going to start flowing and how it gets spread out. That's all that means, okay? So in our 506, when we have an offering, it will be a 506C. We are currently in what's called a safe agreement. So none of this part here applies right now, because right now the investors that are coming in get to take part of an amazing opportunity. Now, what's happening right now is what's called a safe agreement. So any investors that come in now, they do not have to be accredited investors. They can be sophisticated only investors, which simply means accredited means you make 200,000 a year or more as a single, or 300,000 or more as a married couple, and you have to be able to prove it for 2 years, and or you have a net worth of $1 million or more. So if you don't meet that, that just means you fall into the next category, which is a sophisticated investor. Maybe you've bought the primary house you're living in, you've bought some real estate, you have some knowledge. And so that's all that simply means. That's a government thing. We don't make that up. That's all on them. The SEC regulates and watches operators all across this country all the time. That's why we have so many lawyers and it's so expensive. So what's happening right now with the Moulin? If you invest 100,000 right now, because we're in that early stage, remember, we've already got the entitlements done, and now we're going through that engineering and architecture part. So the first $1 million that comes into the project as investors on the equity side are going to be in the SAFE agreement, which means if you invest, say, 100,000, when we go to the horizontal phase and we're starting to do that and we get that bank loan, then you're going to have, instead of 100,000 that goes into that, you're going to have 120,000, because we're going to do a 20% return on that. So the amazing thing about that is you just gained that in like 6 to 9 months. Your money just grew that fast in that quick and short amount of time. Then it'll go into a 506c offering. When it does, this is going to come into play. So this is where the waterfall. So the way that works is, if you invest at that time, if you wait and you don't invest now and you don't take advantage of the additional 20% for early in, if you don't take advantage of that and you wait and you keep watching and you wait till it becomes a 506c, you will have to be accredited. Nobody else is allowed except accredited investors. So if you are a sophisticated investor, you will have missed your opportunity. In this case, the way it works is Class A and Class B shares. The difference is Class A is if you put in 50,000 but less the 250,000, you are going to be a Class A investor. If you invest 250,000 or more, you're going to be a Class B investor. Now, how that money can come in, it can come in through retirement accounts, like an IRA, a 401k retirement, anything that's self-directed. It can come in through cash, obviously. It can come in through 1031 exchange. Monies are accepted in our project, so we have that as an opportunity. Some folks may actually be family offices and things. It can come in through there. If maybe you have a fund that you've already been raising for and you were just looking for a deal, it can come in as a fund. It can be what's called a fund-to-fund model. So in here, if you fall in the Class A, because you only invested, say, $50,000, what this means, you're going to receive accrued interest of 9% preferred. So that means as the time is going on, that first year, if you invested 100,000, we don't have any units done yet, we can't pay you out the cash, you're going to accrue 9%. Then the second year, we start to get units coming in. We may be able to have cash distributions going out. When we start sending those cash distributions going out, what'll happen there is, again, you go up to 9%. So if you had 100,000 and now you can go up to 9,000, that's going to be paid to you first. We won't see a dime. It goes straight to the investors. Investors receive 100% of their capital. So you're going to keep getting that 9% until you're 100K, if that's what you did, or you're 50K, whatever amount you did. If you did 72,000, it doesn't matter. Until you get that original amount back, you're going to keep getting that 9%. It will accrue until cash can be paid out, because again, we can't pay from the dirt, right? We want to keep the costs low so that the homes stay affordable for folks. And then once we've got rents coming in, we have more distributions, now we've gotten past this 9%, we've been able to return all of your money, then anything above that, we turn around and we will distribute to you guys on what's called a 70-30 split. So that means we, the GP team, take 30% of those profits, 70% gets distributed to you guys as cash flow. And that will keep happening until we've completely got to 15% rate of return, and then it'll go to a 50-50 split. So that incentivizes us to do an even better job so that we can get to that 15% IRR faster. Why? Because us GP team make more money in that fourth one, right? So we don't really get paid until you get paid and you get paid back. And then it incentivizes us to do an even better job. The only difference here on the Class B section of it, obviously they invested more. Same thing, they still get that 9% preferred return, but see down here, this fourth one, they still get that 70-30 split. So they make more money on the back side of things. That's the difference between the two. Here's the other part of it. So at the end, on the property that, our first property that'll be probably sold, or on the end when we refinance, in this situation, we're talking about refinancing, all the equity that pull out is referred to as upside. So after all of the property is assumed and built, and you saw we had 32 million that we owed, obviously our project is going to be worth well over 32 million. It'll probably be worth closer to 60 million. And so if the value of the property is 60 million and we only have to pay back that 32 million, that's almost 30 million in equity. Now, we don't want to pull out all the equity, but we do want to pull out a good chunk of that equity, and then we want to distribute it to you. So if now you're looking to potentially split, let's say 20 million. Would you rather be a part of the 50-50 split or the 70-30 split? See, so that's where it's more beneficial for those that invest more, because that allows them to be in that bigger pot. So it just depends what you're trying to do, though. If you're investing through a retirement account, boy, that's a huge boon. But if you're trying to offset and use the bonus depreciation to offset some income that you've got going on, then that part of it also makes a difference, because you're going to get a bigger bonus depreciation. So we didn't even touch on the depreciation, but it is an amazing tool, a little bit more advanced. I'm not going to confuse you with all the details of that. Just know it's just one more tool in the tool belt of what makes an opportunity like this so appealing. Because when you get the cash flow, then you get the upside, and you also get depreciation to offset your taxes and other incomes and things coming in. That just blows it out of the water. But that's where our annualized return, we're anticipating 19% return on your money. Where else are you going to get 19% return on your money? Certainly not the stock market. Even if you sold your house, you get some equity back on it, but you're usually not seeing a 19% return on the money that you invested. It just depends which market you're in, right? So Carrie is your contact. And so what that means is she's got her website here, and she's got an opportunity. You can book an appointment with her where you can ask all the questions you want. Obviously, feel free to reach out and just email her. I know we do have the Q&A and the chat box open for questions. So I'm going to turn that over, because I know Carrie's been watching that, and see what other questions and whatnot that we have going. But I definitely want you guys to understand, this is an opportunity for you to come alongside and address the housing crisis in a very real and tangible way. But you don't have to do the work. You don't have to do the research. You don't have to do the digging. You don't have to do any of that. And that's why it's called passive investing. And that's why the government actually rewards that, and you pay less taxes on passive investing. So it's a great opportunity that everybody has open to them. But if you wait and down the road, when it turns into a 506c offering, you must be accredited. So if you are not accredited, I would not encourage you to wait, because if you wait, you will miss out on that opportunity. So we've already had many people take advantage of the out of the first million. There's only, I believe, 400,000 left. I'll double check that number, but I think that's the case. There's not much left of that first million. So that's for those sophisticated investors. So I'm going to stop sharing my screen right now, and I'm going to let Carrie fire away with any questions that have come in since then.
Thank you, Bethany. Thank you so much. And just for those of you that aren't quite sure, GPs are general partners. That would be myself, Bethany, Derek, and Andy, and we do all the work for you. Like we could do all the work, and the last one's paid, because that's the way the cookie crumbles. Right. And the LP stands for limited partner. That doesn't mean limited funds, that means limited responsibility. So you
and
as an
liability.
investor, huh?
And liability.
And liability, yeah, that too. So you as the investor would be a limited partner, which means you would not have to do hardly anything. We do all the work. You get your money back first, and you get the biggest chunk of it, of course. I just put my Calendly link and the website link also in the chat. So feel free to check those out. If you're not sure whether or not you're an accredited investor or sophisticated investor, schedule a call. I'd love to sit down and chat with you, and we can go over what those both mean and figure out what you are. Looking at the questions, I've been taking notes. There was one question that I think, Bethany, you already answered. Will you build a percentage of houses and then fill them before building more? We're going to, correct me if I'm wrong, but we're going to build them and then fill them as we go along. Is that correct?
Right. Yeah. So literally house by house. So like we've already got 8 houses done, and they were filled the day that the house was done.
Awesome.
Because we already have waiting lists. So yeah, so we won't build like 100 and then wait. We usually do 10 to 12 starts a month. And then during that time, they're getting done at different times, and we're so what that means is we're putting it out there. People have the opportunity to literally the day that it's done, they could be moving in that day.
Great. Awesome. We also have a question. How do we get us the funds should we decide to invest?
So great question. So Carrie has a portal, an investor portal. And in this investor portal, she'll send you the link. And in that link, you basically just create a login, and it is secured. So again, we have to follow SEC guidelines. We are required for cybersecurity and a bunch of other things. So that's why there's a portal, okay? And that's why it's yours. So you have access to it. Once you create this login, you can get in there. You'll see the Moulin opportunity in there, and you just click on the opportunity, and then there will be a button that says invest now. When you click on that opportunity, it's going to give you all the offering documents. So in this case, right now, for the last little bit that's remaining in that first million, the safe agreement is in place. So that's in there. It'll allow you to download that safe agreement. It will allow you to take it to the attorney, get your attorney to look it over and check it and see. Then once you're okay with everything, you've asked your questions, it'll allow you in there to electronically sign it. Once you've electronically signed it, then you'll get wire instructions sent to you. Those wire instructions, you'll want to call and confirm. Again, we always want to make sure that there's no, fraud with emails and things. Call and confirm, make sure that's all correct. Let us know where the funds would be coming from, if it's from your IRA account or another retirement account of some kind, or if it'll be coming from a specific bank like Chase Morgan or something. And then once the wire has been received, we confirm that with you. Yes, the funds are received. Once the wire is received, that is when you're in, not when you sign the documents. It's based on when the funds are received. That's when you're in. So at that point, it is always first come, first serve, because once we have enough, we're not going to over raise and again hurt our investors. We want to make that simple and clean and keep their shares protected.
Wonderful. Somebody else asked when and how distributions are going to be given. Like, are they monthly, quarterly, and how will that be? Will that be wired to their account or what?
Yes. So when distributions can start happening, obviously we can't start them when we don't have houses, right? So we have to wait until the houses come in, and we have to wait till rents start coming in. And we can't start distributing them when we have one rent done, because who wants a $5 check? It's not worth the time or energy, right? There needs to be a certain amount of them done to pay for the expense of it and blah, blah, blah. So when we do that, you'll, in the portal, you'll give us your ACH, like your routing number and your bank account number, and it will be directly deposited into your account. It will be done on a quarterly basis, but this project is not like a typical multifamily renovation. Cash flow is not going to happen day one. It'll probably happen year 2 and 3. You'll start to see cash flow start coming in. And again, that's because we got to get from dirt to buildings, and in that process all along the way. And then you'll start to see it set. Once it starts, you'll see it steadily going in.
Wonderful. We also have a question. When would be the deadline for collecting funds?
Well, the deadline is first come, first serve. So once it's full, it's full. So right now it is not full, and you can still get in. I can't guarantee next week that that's going to be the case. Once we have, once we move over to the 506C offering, And that's, you know, publicly being out there. Same thing. We're only raising a certain amount of money. So once that money is raised, it's closed. Nobody else can come in.
And Bethany, you had also mentioned a 1031. Can you briefly explain how that works for those people that might not be aware?
Sure. Yeah. 1031 exchange is an IRS tool that was created so that if you say sell your house in California and you see a profit of above $250,000, the IRS will tax you as a capital gains. So what they've done is they've created a tool called this 1031 exchange. So what you can do is you can work with a third party intermediary, and you basically identify the property that you're going to take. Say you made $400,000 on your house. Instead of you taking it as income and coming into your bank account, you work with that intermediary, you identify where you want the money to go, and you do it within a timeline. You have like 45 days to identify the property and then another 45 to make the money and transition all happen. So basically the money then leaves from the sale of your house in the same tax year usually, but you can carry over if you need to. And then it goes into another deal. So it's invested and it's now in real estate. And as long as it's like in kind, so for instance, real estate to real estate kind of thing, then they allow you to do that and not pay a dime of capital gains. So that is huge because now you're not going to get another hit on that. You're not going to, and your investment, the money that you got is still going to keep growing. So it's a great and tremendous tool. There's a cost to it. It's not cheap, but depending on the amount of money, it may be worth it for you. For some people, they decide it's not worth it for them and they just invest their money alongside and do some other things. So it just depends. Everybody's situation is a little unique, but that is opportunity. Not all operators allow it because it is a different structure. We have to separate those shares for those folks that come in as a 1031 exchange.
So would a 1031 be exchange be allowed on this deal?
It is allowed, but we really don't look at them below 300,000. Usually it's about $500,000 and up. So if someone's got a, you know, pretty decent size 10, then, because like I said, there's an expense to it and a lot of time that's involved.
Okay. So if you're more than 350,000, that might be something you could look into and we could discuss.
Yeah, absolutely.
All right. Well, thank you, Bethany. You have been wonderful and you're explaining. I can hear the teacher in your voice. Being a teacher myself, and thank you for your time. I know your time is very valuable, and thank you to our audience. I know your time is very valuable too. So we are going to end on time. I just put my Calendly link and my website in the chat again. Feel free to reach out. My website also has email, as well as all my social media contacts on there. You can reach out any which way you want to, and I'll get in touch with you and we can sit down and chat about your investment goals and where you want to be headed and whether or not you want to come alongside myself and Bethany and Andy and Derek and do something about this housing crisis in America.
All right. Thanks so much for having me, Carrie. I'm so grateful to be here. Hope you guys have a great day, and I'll look forward to talking to you guys again.
Great. Bye-bye, everybody.
Bye.